And then we'll see how far we get on the it's on reporting. It's a 3-pager. It's a small one, and hopefully we can get through most of that, if not the whole thing. It's so yeah, and that's what the last test will be based on, the Module B stuff, which is I think the hardest stuff, and then also the Chapter 12 handout stuff, which is the audit report stuff. And that'll be it. And so then I'll send you guys out a test, maybe tonight or tomorrow. I'm going to try to get it out tonight, but the test on Module B in Chapter 12. Question on that? Okay, well, let's jump right into the handout. And I got the wrong handout. Let's try this again. There we go. Had fun. You learn how to use a computer. Okay, so I think we got two. That's it here. So we got the page. I think we're on page 5. It might be a little bit different. I can't remember if I changed the, but where it says independence, employment interest of covered members. Okay, so a client's employee gets hired by the CPA firm. That's fairly unusual. Usually, if someone if there's an employment issue, it's someone going from the CPA firm to the client. That's much more common. The CPA firms generally don't take employees from their clients. First of all, they don't want to be stealing employees from their clients and getting them mad and losing the audit. It doesn't help them. But it is a much more rare thing, and it's unless they have some kind of specialized background that wasn't available to or they didn't need anymore, some kind of programming thing or something. It's hard to imagine that happening very often, but it can. So an employee goes from a client's employee. So someone working, say, at IBM, goes to work for the CPA firm that's doing the audit. Okay, again, that's probably fairly rare, but it can happen. It's certainly in the realm of possibilities. Okay, so okay, a former employee for the client cannot audit their own work. All right, so which obviously it's a objectivity or bias issue. So if someone comes in, well, let's go to the case. Oh, I gotta do the poll. Okay. So Gracie worked for IBM in the accounting department and was recently laid off from her position. Gracie took a job with IBM's auditors. Can Gracie participate in the IBM audit? What do you think? And either blurt it out or put it in the chat. No one? Oh, come on.
Is it no?
Yeah, she can't come. No, yeah, because she'd be auditing her own work. What did I use? Green, okay. Yeah, so she can't be auditing her own work. So no, she cannot participate. Now, from an auditing point of view, you say, well, hey, we got someone with the work there. We can use them on the audit. They'll know everything. You can't do it. They'll be auditing the work. Now, as time goes by, a year or two goes by when no longer is her work part of the audit or part of the financial statements, then yeah, then you can get on it. But it can't be auditing anymore. Okay. A CPA firm employee gets hired by the client. This is very common. A lot of times within a CPA firm, and one of the good things about being in a CPA firm is, first of all, a lot of people leave CPA firms. It's very tough. It's very tough work. It's long work. It doesn't get easier as you go up. You'll work as many hours when you're a partner as you did when you were, or more. So a lot of times people do leave CPA firms. A lot of times the CPA firms will try to get you a job with the clients. So if we're auditing IBM, they'll give a call of IBM. Hey, we got this senior auditor. We don't have a spot for him, but great person, and do you have a spot? And a lot of times they look very highly upon the CPA profession, and so they say, yeah, send them over. We'll find a place for them. So that's very common. And the reason the CPA firm, you wonder why the CPA firms do it. Why don't they just kick them out the door? Well, they want to have sort of their people in the company so that when the question comes up, who should our auditors be? Well, whoever the auditors are, that's who's going to be there. So that's part of it, is to try to get them, trying to get sort of colleagues, if you will, into the company. So if it's a non-issue, if the CPA firm employee is accepted or is still considering the client, they must be taken off the audit. So if they have accepted, so they get an offer from, let's say IBM, or are still considering. So they've not accepted, but they're still considering the job offer with the client. They must be taken off the audit. Because there's that potential there that they will have been, that there will be virtually an employee of the client would be working on the audit. So they must be taken off. Now, if they already rejected the offer, there's no problem. Yeah, so if IBM made them an offer and they rejected it, that's not a problem. But if they accepted the offer or are still considering, yeah, there needs to be a comma there, isn't there? I think I gotta put accepted job offer. I don't know. Write what I know about English on the postage stamp. But yeah, so okay, so they must be taken off the audit. Now, issuer. This rule still applies. Oops. But also, let's make this. Okay, so that rule still applies. If the client is an issuer, there is an additional level though. If the CPA Firm employee is being hired for a key position, he must be off of the audit for an entire audit cycle. I'll explain what that is in a second. Okay, so if it is a key position, it must be off the audit for an entire audit cycle. And so key position, we're usually talking about people who are up the ladder, and these would probably be in the finance area anyways. But so they're being hired for a key position, they must be off the audit for an entire audit cycle. Now, that can be very tricky. I'm trying to think of the best way to do it. I don't know, I'll do it right here. We'll see. Just warning, this might be a complete train wreck, but hey, ain't like I ain't seen one of those before. Okay, so here's what this means. So let's say that this is 2020. And this is, oops, 2021. You probably knew that was coming. So let's say this is 2000. Okay, let's say that on March 1, get the offer. So March 1, 2020, you get an offer. You get to the end of the year, you haven't been off an entire cycle. You have to wait until you're off an entire audit cycle. So the entire audit cycle will be 21. You're on it in this cycle. You got to wait for the entire 2021 cycle so you can take this job on January 1st. January 1st, 2022. So March 1st, 2020, you get the offer. You cannot take that job until January 2022. Now, you may say, well, that seems pretty severe. That seems pretty long. You know, you'd be waiting over, you know, you could be waiting a year and 10 months for it. You know, it is. And here's why that rule is there. Oftentimes, in a CPA firm, a manager, if they were not going to make partner, they would kind of be positioned to be a controller in a client. So here's what would happen. They have this person who was the manager, pretty high up in the CPA firm, and they would be sitting across the table when it came to the audit from people that they trained. It would literally be, you would be talking to your supervisor, who used to be your supervisor, who trained you in auditing, would be sitting across the table from you. And they decided that that was not such a good scenario. So that's why they came up with this rule. This rule is very interesting. It's interesting because it doesn't put the onus on the employee that's moving to the client. They put it on the client. A corporation cannot hire someone has not been off the audit cycle for an entire year. So they're in violation. It's the company. So if IBM hired somebody, that the company would be in violation of the PCAOB rules, not the employee. So this is the burden is on the company not to do this. So these are the rules. Now, again, if it's not a key position, then it's fine. But if it's a key position, yeah. Now, this does not apply for non-issuers. This is only for publicly traded companies. This is only for issuers. Right. So non-issuers, that rule doesn't apply. They still have to be taken off the audit for both of them, if they're considering it or have accepted. But if it's a key position, they must be offered entire audit. Okay. Sam is a member of the IBM audit team. He's offered a job at IBM. Sam was not accepted or rejected the IBM offer. Can Sam work on the IBM audit?
No.
No.
Still considering it, so Sam cannot do it. Now you may say, well, it doesn't matter. This is just for any job offer. No, this isn't for a key position. So this for any job offer, take them off the audit. George, member of the audit engagement team. He recently got a job offer from IBM. The job is for a staff accountant. Can George immediately accept the IBM offer?
Yes.
Yeah, a staff accountant is not generally a key position. And by the way, this is where you'll see most people who would take a job with the client, they probably would come in as a staff accountant. You know, so it's not like they're going to be key to the audit. Lisa is a member of the IBM audit engagement team. She was got a job offer. That was for the controller position. The controller is, of course, the head accounting person in the company. Can she accept it?
No.
No, yeah, it's a little bit of a misnomer there because it's actually IBM couldn't offer it to her, but she can't take the position until she's off it for an entire cycle, whenever that is. Now, again, they could give someone a non-key position job until then. Okay, non-issuer. Mickey's a member of the Geo Corp audit engagement team. Geo Corp is going to be a privately held company. I can almost say it. She recently got a job offer from Judo Corp as their chief financial officer. Can Mickey accept the offer?
Yes.
Not a publicly traded company. It is a key position, but for a non-issuer, there are no key position rules. That's only for publicly traded ones. If you think about it, a lot of times those companies, the privately held companies are usually smaller. Not all, there's some big ones, but a lot of them are smaller. So if you're going to leave a CPA firm, it probably is going to be for a higher, a key position, just because it's a smaller place. You probably wouldn't leave a CPA firm to work as a, entry-level accountant or anything. Okay. There's on that. Okay. Employment interest of family members and close relatives. All right. Family members and close relatives that work for a client can also cause conflicts of interest. Family members and close relatives cannot occupy key financial positions. It's probably to say with the client. I don't know. Probably doesn't matter. All right. So now this is an important distinction. So key financial positions. So in the past, the wording was just key positions. Okay, so and this is for all, whether they're publicly traded or not, that if they were in a key position, it maybe has nothing. It could be director of marketing or something like that. Recently, they've kind of changed that. They've kind of altered it a little bit to say, well, it has to be financial. It has to be somebody who has an impact on the financial statements. It has to be a key position of somebody who has is sufficiently in the finance area that they have some kind of input with the financial statements. So if it's vice president of marketing, it's probably not that. It's probably not. It's not a key financial position. They probably don't have a whole lot to do with the financial statements. Now, if they do have something to do with the financial statements, then it's a no-no. But generally, it has to be, the key word there being financial. Okay. Sam is a member of the Up One Corp Audit Engagement. Sam's mother is the chief financial officer of Up One. Is Sam in violation of the independence rules?
Yes.
Yep. And again, these are somewhat a little bit, they can be somewhat controversial. And again, these are the I don't know specifically if there's court cases on these, but on the key position one. But I do know that for owning of the stock and stuff, there have been lawsuits. People say, I have nothing to do with the stock that my mom owns or whatever, and I should be able to do the audit. But so yes, Santa is chief financial officer. That's a financial position. It's a key position. So. Okay, Mary is a member of the Up To Corp Audit Engagement Team. Mary's father is the director of design at Up To. Is Mary in violation of the independence rules? What do you think?
No.
Probably not. And this is the director of design. I'm not even sure what it would be, but it doesn't sound like a financial position. If it is financial, then no. But just looking at it, it probably is more along the line. It's probably some kind of a design firm or something. So is he in violation of rule? No, because it's most likely not a key financial position. it might be a key position in the company, but it has to be financial. And again, that's a little bit of a change of rules. It's kind of come about in the last, I don't know, 2 or 3 years. That what they're looking for is key financial positions. And if they have any input on it, then it is a key financial position. Okay. Now, any questions on those? So family members can't be in key financial positions. Yeah, family members and close relatives cannot be in key financial positions. And those are ones, those are ones that they're probably not a lot you can do with them. If it was just simply selling stock, you could ask, your parents, I doubt that Sam's mother is going to give up the chief financial position to chief financial officer so he can do it. So he can do an audit, or she can do an audit. All right. All right. Independence, employment and financial interest of non-covered members, and non-covered members are partners and professional staff. So if you're a partner in the firm or your professional staff, you are a non-covered member. So you are not going to be held to these higher standards that the covered members are. But there's still some standards you're going to be held to. And the question is, what are those? And I'm going to go all the way back to day 1 up here. And basically, basically, it's all these people who are not covered members, but they're still professional. And when we mean professional, usually a good way to think about it is someone who has a college degree. So, these are going to be the people we're talking about. So if you are a senior that's not in the audit engagement team, if you're a senior, covered member rules don't apply to you, right? However, there are still a couple of rules that apply to these other people. So this is for non-covered members. If they're covered members, they got all these rules. You can't do this, can't do that, blah blah blah. But for non-covered members, there are still a few rules. They're much more relaxed than the other ones, but they're there nonetheless. So let's go to them. Okay, financial interest. Non-covered members. Non-covered members cannot hold more than 5% ownership of the client. And if anyone so you could be a senior in wherever, and if this is the case, the entire audit firm is not independent. Remember, the audit firm is a covered member. So the entire audit firm is not independent. It doesn't go to any individual. You know, this could be somebody who is not related to anyone on the audit. But if they own 5%, more than 5% of the ownership of the client, they can't do the audit. The entire audit firm itself is not independent, and the audit firm is a covered member. So the audit firm, which is a covered member, is not independent. Now, for publicly traded companies, it would be hard to imagine this coming into play. If you own 5% of IBM stock, you would probably be living on a private island somewhere with yachts and helicopters and stuff. But for smaller companies, it can happen, and it's not too uncommon to have someone who has a family business who may have gone into accounting and working for a CPA firm, who maybe still owns an interest in the family business. Maybe it's a chain of grocery stores and they're an 8% owner. Even though they're not working in the grocery store business, they might be an 8%. It can happen. Usually not when they're public, but certainly when they're private companies, it could happen. And again, if they have more than 5% of the client, the entire audit firm is not independent. So it isn't like they can own, unlimited amounts of stock in a client, but employment issues. Covered members. Yeah, cool. For management positions, or be in an oversight position, which I'll talk about in a second. Oops.
Non.
Yeah. Covered members are something completely different. But non-covered members may hold a management position, may not hold a. Now, an oversight position oversight position is usually on the board of directors. Okay, so when they talk about oversight, it is the board of directors. Now, it could be a regular person on the board of directors, a regular director. It could be someone on the audit committee. It's usually a subset of it. But the oversight position is that they are in charge of looking over the company. So you can't be a member of upper management, and they usually are looking at the director level or above, depending on what the director level is. Sometimes in banking, that everyone's a director. You'll come in from first year out of school, you'll be a director. But so generally looking at people higher up in the company, you can't be in upper management, and you can't be on basically the board of directors. Okay, so let's go down here. James is a senior auditor for a CPA firm that audits IBM. However, James is not a covered member for the audit engagement of IBM. James is also an ordained minister and recently accepted a position on IBM Board of Directors as a spiritual director. James is not on the audit committee at IBM. Will James' position impact the CPA firm's independence? What do you think? Anyone? Oh, come on. It's yes or no. Flip a coin.
Yes.
Yeah. Yeah, it's going to impact the position. It doesn't, you know, well, his, what am I doing here? Well, his participation on the board may have nothing to do with, anything with the audit. Cannot be on the board of directors. It does not, it's an oversight position. So it will interfere with it. There is an exception to this rule. So here is the exception to the rule. I tell you the exception to the rule because a lot of times on the CPA exam, they're just like you to ask you about the exception there, what the rule itself is. If the director, if the board of directors position I'm left missing an O there. Yep. It's completely honorary. Oops. Oops. Okay, so if it's purely an honorary position, that's allowed. And where this usually comes into play is for things like not-for-profits. So your CPA firm, you audit a local community college, and they have fundraisers and all this kind of stuff, and they say, hey, can we give you this position on the board of directors? You don't have to show up, or a couple times a year you'll come and stand around and talk with donors or something. But you're not going to vote on anything. It's not, it's an honorary position. There's no voting. You're not going to be doing any voting for things or anything like that. If it's purely honorary, it's allowed. Okay, so and again, this usually comes about by things like charities, not-for-profits, things along those lines, where a lot of times they will try to, as a CPA, you hold some prestige in the community, and they want you on the board of directors to add to that prestige for their, whatever their cause is. So if that is the case, it's allowed. But again, it has to be completely honorary. If they have you voting on stuff, voting on expansions and all that kind of stuff, no, you can't do that. But if it's purely honorary, you can. Okay. A lot of this stuff, I think I'm going to skip and go right to the end, I think. A lot of stuff in here. Okay, this is what I'm gonna do. I want to go, let's jump right to the end. I want to go over this. And unfortunately, I don't have this set up. Get rid of some of this stuff. So the last page looks like this. I'm not sure if it's 9 or something. And I think I stole this out of a textbook or something. But this is a kind of a compare and contrast for things that are allowed and things that are not allowed by the PCAOB, Sarbanes-Oxley, and the AICPA. as you go down the list here, we're gonna find that most of the stuff the PCAOB does not allow. So if it's publicly traded, you can't do it. AICPA, most of these you can. All right. So, and before PCAOB came along, you know, it would have just been the AICPA code of conduct. They could have done most of the stuff. And a lot of it was done by the auditors. Now, this is only for the auditors. This is not for a CPA firm that's not the auditor. So if you're, you know, let's take this first one here, bookkeeping. Sarbanes-Oxley, you can't do it. AICPA, you can. Now, if you're not the auditor, if you are a CPA firm and you're not the auditor, you can do their bookkeeping. It's the auditor that can't do the bookkeeping. Okay, so again, you know, these are for the auditors. If you're not an auditor, these Sarbanes-Oxley rules are not going to apply. Okay, so AICPA code. So yes, and then people raise their eyebrows. Say, really? Yeah, you can do the basic bookkeeping for a client and still do the audit. Basically, if you make any journal entries, the client will have to approve them before they get entered. But the basic bookkeeping can be done by the CPA firm. They can't approve journal entries that go into the actual financial statements. That's a managerial job. Oh, oh, you know what? I gotta tell you something else before I go on with this. I just realized I forgot this. You cannot, this is PCAOB, and do not allow auditors to make management decisions. So if there is a management decision, you cannot make it, period. If there's a decision made by a manager, so, you know, if it's hiring somebody, if it's dispersing funds, if it's whatever it is, you cannot do management decisions. And that's both of them. Okay, financial accounting system installation. You probably saw this coming. No for Sarbanes-Oxley. And yes for the AICPA, as long as it is not their own accounting system. So if it's an off-the-shelf system. If they made the system themselves, they would be auditing themselves. So it has to be an off, like Peachtree or QuickBooks or something like that. Appraisers evaluations, no. Appraisals or evaluations, generally no for this one too. Especially if they're part of the appraisal of the for what goes on the books, for example. There are a few exceptions that if there's clear guidelines on the appraisals, there's no leeway in it. But for the most part, if there's any subjectivity in them, you can't do it. Internal audit functions for the client, no. And yes. This is one of those weird things. Internal audit are the people that are inside the company that are doing the audit. It'd be hard to imagine that not being just astronomically expensive to have a CPA firm doing it. I know there's places that have that, but it's got to be just like, CPA firms are just really expensive. I was wondering, you certainly wouldn't be saving any money doing that. I'm not sure. Management or human resource recommendations. Generally, no. And this one is it generally no, as long as you are not actually doing the as long as you're objectively carrying out your management recommendation. So for instance, if you're just doing a search and giving them a list of people or something like that, that'd be fine. But as long as you're not specifically saying, hire this person, that person. But generally speaking, you're as far as individuals. And this is another thing that used to be kind of strange in that CPA firms, a lot of these CPA firms would actually be the ones that would actually go out and look for, say, a chief financial officer or a chief executive officer of a client. It's kind of crazy, and the chief executive officer would probably be more aligned with the auditors than with the client. There were actually companies that were kind of run by the CPA firms, basically. Investment service recommendations, no. AICPA, yes, as long as you are not giving specific financial instrument. You're not specifically saying which company to buy stock in or something like that. The actual financial instruments, stocks and bonds. You can tell them general investment allocations. So for instance, they say, well, you should have about 30% in the stock market and maybe 10% in bonds, 10% over here, whatever, real estate. You can give them general terms of allocation, but you cannot actually pick out, okay, here for the for the stock companies, these are the ones you have to pick. You can't do that. But you can give general allocations. Legal services not related to auditing. Generally, no. And for AICPA, yes, by default. The AICPA actually has no rules on it. And because there's no rules on it, there's nothing they can hold you to and say, hey, it says you can't do this. So there actually are no rules. It doesn't say it's allowed. It doesn't say it's disallowed. There's no rules on legal services. Tax planning for common issues, yes and yes. If they're common issues, you can do it. So, the piece of equipment, how long do we depreciate it over? That's, you go look at the code, it'll tell you what table to use. You can go and do, those are common tax issues. There's nothing unusual about them, run of the mill. For common tax issues, you can, both if you're the PCO, the PCOB rules, or for AICPA rules. Tax planning for unusual or aggressive tax issues. No. And no. The CPA firm the CPA firm cannot be an advocate for the client. And that's either rules. You cannot be an advocate for the client. You have a role as sort of a police officer or something like that. You cannot be an advocate for the client. And they may want you to. They say, well, why don't you come in and talk to our bankers? I didn't tell them like you were, we're good people and that we do everything on the up and up and all that kind of stuff. He can't do it. You cannot give a stamp of approval on it. All you do is on the financial statements basically say whether they can be, they're fairly presented or not. That's all you do. You cannot go in and argue. Now, if they're doing unusual or aggressive tax issues, you are going to be in there arguing with the IRS or the state auditors, or whoever, or state, or tax collectors for the client. You can't do that. You can't be an advocate for the client. And that's one of the things, you gotta let the client know, look, I can't, I can't go to the bank, to tell the banker what a great person or a great company you are, whatever. So you cannot be an advocate. Individual tax services for officers. No, this used to be very common. Whoever did the taxes for the corporation would do all the taxes for free for all of the people higher up in the company, officers. CPA, yes, it's not uncommon for that to happen. And if you think about it, a lot of times they're small businesses, a lot of times doing their businesses and their business or corporate taxes and their regular taxes, they're pretty much intertwined. You can do both. I'll tell you, I don't know if it's funny or not funny, but these individual tax services for auditors, I remember reading about a firm that these Sarbanes-Oxley rules came about, and they couldn't do it. A couple of the officers said, well, I'm going to go have our CPA firm do it again anyways, because I had them do it last year, and they're going to do it again. So they went and they had the CPA firm, they do their taxes, which is a no-no. The company, I can't remember what company it is, but the company, I'll look at it. I'm sure I got it in a case somewhere. The company fired the two executives rather than the CPA firm. They said, "Oh, wait, we can't. This is a violation of the PCAOB." And they literally fired the two officers in the company rather than replacing the CPA firm. So you cannot have, the taxes cannot be done for the upper level. And that again, that was a very common practice. Everybody got their taxes done for free in the upper levels from for their auditors. Okay, any questions on this? Okay, I think this only went up through 18, didn't it? For the multiple choice. These are not there. I gotta figure out some way to put these on. Okay, so answer 11 through 18 on there, if you have not already. And by the way, these are tracked by individuals now. So, and only those individuals that answer get extra credit, or get the credit for doing the handout. So turn these in. For 19 and 20, you can put anything. It's not going to matter. But so go ahead, and again, and now I can see the people's names. Other people can't. So if I share these results, no one else can see the names, but I can see the names when I download. And I think we'll go ahead and take a break. Let's say. Be back at like 7:05 maybe. And we will start chapter 12. Okay. So we're back at, and I get turn in the multiple choice 11 through 18, and then just again 19, 20, throw in anything. Yeah, but and that's what I'll use for the handout. So once I get those, that's what I'll take the for the handout. In other words, you won't have to turn in the handout. And now, if you weren't here last week, then you have to turn in the first part of the handout. But if you were here last week and you did the multiple choice and you did it this week, I will put those in for you for the chapter 19. And I do the same thing for the chapter 12 that we're going to do next. Hello. Okay, anyone still putting in the multiple choice? See if you can't put them in the next few minutes here or so. 'Cause I get at the end of the polling, because I got to bring up the other poll for the next handout. The next handout is the on chapter 12, which is on reporting, and it's going. I just want to go through there a little bit, and there's just some things on reporting that are good, and I think that we can cover these without a problem. So let's go ahead and pull that up. Okay. So a few of these are kind of a little bit technical, and when you sit for the CPA exam, you're going to go over that these audit reports quite a bit, especially the standard report. And the reason we go to the standard report more than anything else is that's a report you're going to use more than anything else, for a number of reasons, which we'll get to later. But so the standard report is what they call a unmodified report. This is somewhat new terminology. It's about 5 years old. Sometimes called unqualified, clean, or standard opinion, or standard report. So this is all the, a normal report that most people get. Okay. And it has all of the following elements except, and there's one thing on there that we do not do for non-issuers, non-public clients. Anyone? You want to throw a guess out there?
Management responsibility?
They actually will have that. The one they won't have is the internal control one. They'll mention internal control. They'll say, we take into account internal control. However, they do not issue an opinion on it. Now, for publicly traded ones, they do. So PCAOB, they'll issue an opinion on internal controls. But for non-public, they don't. And again, and by the way, in the CPA exam, they use non-issuer and issuer all the time. That's the new thing. So you'll see that rather than public or not public. And issuer, it just is sort of short for being they're required to issue statements with the Securities and Exchange Commission. So they call them issuers. Okay. Number 2, this one's a little bit tricky. They still have the management responsibility. They have everything here, except they do not have a statement on management fraud. There's no statement on it. And that's kind of technical. And these are hard, by the way, because you're looking for something that is, the negative, what's not there. It's a lot easier to look and see what is there than what is not there. But that is not there. So these are the unmodified clean opinions. Okay, now it's let me do it on this paper. You know what I'm thinking about getting? I'm thinking about getting one of those things I can't think of. No, those digital whatever, digital pads or whatever that you can write on. Because I think that would be a lot better than doing this, maybe. Okay, sort of like this. Well, you'd have the So you have the unmodified opinion, which is a clean one. Put an extra I in there. So here's that part of the report. So this is the audit report. And then on the bottom here, a lot of times they'll tack on an extra paragraph. Now, the report is still unmodified. It's still a clean opinion, but this paragraph will be tacked on the end. And they come in two different forms. Emphasis of a matter. This is something that's already reported. And then there's other matters. Oops, two T's there. Other matters are things that the CPA firm, the CPA has control over. Man, do I write terrible. So emphasis of a matter is something that's already reported will be in this, can be here. Other matters are things that they may be already reported, they may not, but they're things that the auditor says things are important to go along with the, report. So what we're talking about here for these emphasis of matter and other matters, which I know are kind of crappy the way I wrote them, but these are, it's an extra paragraph. The opinion is still clean. Free of material, misstatement, all that kind of stuff. But this is just an extra paragraph put on the bottom of it. And it's still a clean opinion, although some people may not think that. But okay, so let's see here. Okay, so emphasis of a matter. Oh, wait. I'm sorry, I didn't put the new poll up. I got to close this one. I think I told you this before, but when it has me save these poll reports, they all save it as the same one. It's so irritating. You think that they have like the date, time and all that kind of stuff. None of that. It saves it exactly the same report every time. Okay, so this is accounting 330, chapter 19. Okay. Oh. Did the poll come up?
Yeah, it did.
Okay, good. Okay. So on the poll, number one was C. And number two was B. Okay, going concern opinion. This is a paragraph that's put on. Now, it can accompany can a company that's going bankrupt, can they make their financial statements correctly? What do you think? Yes or no? So a company, they're having trouble, they're going bankrupt, they make the financial statements. Is it, can that be done? Can they make their financial statements correctly? What do you think? Yes or no?
No.
They actually can. They're going to look terrible, right? But they actually can make their financial statements correctly. I mean, like I say, they'll look bad, but so here's what would happen. A company would make its financials that's going bankrupt, make their financial statements. They look terrible, and they go bankrupt. And then you'd see on the news, this company went bankrupt just 3 months after getting a stamp of approval from their CPA firm, their audit firm. How'd this happen? Well, we were just looking at the financial statements. We weren't saying that it was a good investment. We never say that a company's a good investment. We didn't say IBM's a good investment or Ford is or anything else. But there was that gap that the public thought that if you gave a clean audit report, that meant that the company was a safe bet, right? So that's where this going concern thing came. So you give this to a client when it looks like they're not going to make it for a period of time into the future. And so what is included in that is all of these are basically included. And I'll talk about those. When it is issued when a client will likely go bankrupt. This is the one we're going to have to modify a little bit. Use the terminology substantial doubt. And that is when there's substantial doubt that they're going to be able to continue in the future. Requires financial statements disclosures. And here's another thing. When you determine that the company is a going concern, you will insist that they put that in the footnotes. So they will have in the footnotes that they have there's substantial doubt about them functioning as a going concern. All right, so the company itself will put it in the footnotes. And that's why this is called emphasis of a matter. It's already going to be reported. It's going to be in the footnotes that they are telling the reader, look, things are bad. Here's the heads up. They may also consider management's plan. So if, let's say they're doing really poorly, but management has a plan. They say, look, we're gonna sell off this division. That'll give us some cash. We're gonna lay off these people. We're gonna do this and that. We're gonna, if they have a plan in place that looks feasible, you don't need to give it to them. You don't, if it doesn't look like you're gonna go out of business, with this plan, you don't need to put a going concern paragraph on there. There was an airline that got a going concern from their auditors, and they said that they came out and made a statement that they disagree with the auditors because they're going to sell these routes and they're going to do this and that. And the auditor said, well, if they had those plans when we did the audit, we wouldn't have gave them a going concern. So if they have a plan in place, sometimes it's a wake-up call. Okay, this used to be the time frame for the U.S. companies. It was 1 year for U.S. companies. If they're international companies, it was within 2 years. This has been modified a little bit, and it's modified. The overhead thing here. It's sort of like this. So let's say that this is 2020. So this is December 31st. So that's that's their year end. And let's say that their audit report comes out on say March 15th. In the past, the year would be from here to here. The new rules are that it's for the year from when the audit report is issued, not year end. So they would be looking at between March 15th, 2021 and March 15th, 2022. So there'd be these extra months in there that they could go bankrupt that you would have to report on. It used to be that if you didn't think they're going to go bankrupt by year end, that, you know, that's what you have to give them a going concern. But now is if you know, it's a longer period basically. And they also say now that if if the auditors think that it should go past that it can. So they can actually go past the 1 year even from the issuance of the audit report. So this is the problem. It's not from year end. It's from the date of the audit report. Oops. The audit report is issued. So this is no more. Okay, emphasis of a matter for issuance for generally accepted accounting principles not consistently applied. Okay, so this is, for instance, for example, now this is only for GAAP to GAAP. So generally accepted auditing principles to generally accepted auditing principles. So if we're going like, so let's say from LIFO to FIFO. Oops. I don't like the way I wrote that. Okay, so it must be for GAAP. You know, they were talking about going from one GAAP rule to another. Now, this can come about for any number of reasons. It could be that you know, the auditors think they should change. It could be a new accounting rule comes out. The new accounting rule comes out, you know, that they weren't following last year, for example, and a new rule comes out that they have to follow. Then you're going to tack on this extra report, this extra paragraph. Okay. So which one of these would most likely be it? I'll tell you when it's not. It's not this one. This isn't about changing an audit accounting estimate. So if you have a piece of equipment that lasted for you thought it was going to last for 3 years and it lasts for 6, that's a change in estimate. That's not an accounting rule. So which one of these following 3, which ones do you think would probably be the one that would apply to this emphasis of matter? going to make it even easier. It can't be B. And you might ask, well, why can't it be B? Oh, wait a minute. B is used if management adopts an unacceptable accounting rule. This isn't for that. If they have an unacceptable accounting rule, they get a bad audit report. This is a clean audit report. This is for things that are GAAP. So a bad accounting rule isn't GAAP. So between C and D, which one do you think is going to be the one that they would give an extra paragraph to? Yep. Yep. Just got it on the chat. D. So even if the new rule is used by management, even if management has justified the new rule, the new principle, has justified the new principle. Okay, I can't read, but this is the one. Yeah. Now, if the impact is immaterial, it doesn't matter, right? I mean, if it's not material, you're not going to put it in the audit report anyways, most likely, because the impact isn't significant enough. But so you know, when for instance, a new accounting rule comes out, companies will get this, and they get tacked down. So whenever a new accounting rule comes out, about 10 years ago, a whole bunch of accounting rules came out in 1 year, and I remember seeing an audit report that had 6 of these on it. It had 6 accounting changes on it because they had to adopt these new rules, and so they had to put it on there. And there's nothing wrong with it. It was a clean audit report. But because these new accounting rules came out, you know, they had these 6 paragraphs added onto it, and it would say, okay, they had to change from this to this, and the impact was, 17 million was, whatever it was. So they put the impact in there too. But again, these are very common. It seems like they're trying to get away from this for the reason I just said. They'll get a clean audit, and there'll be these 6 things tacked on it. Yeah, so if the new accounting rule comes out, they get it. And again, we don't really, if something is immaterial, the general rule is you leave it out of the audit report, unless there's something that makes it material, is left out. Okay. Okay, other matters. And other matters, first of all, should be formatted better. But other matters, and these are that the auditor has discretionary over. What that means is these are things that the auditor can choose to put in the audit, to tack on a separate paragraph or not. And they usually are there in case there is something different. If there's something that you really think that the people reading it wouldn't understand or about this company, that needs to be said. I'll give you an example of something you wouldn't put in here. Suppose you're auditing Ford. You say, okay, well, people drive cars and they get in car accidents, people get killed, and so they can get sued. So we should put that in there. Well, no, every car company has that. People drive their cars and whatever and get in car accidents. That happens every day. That anyone who investing in Ford should expect that. I mean, that's part of what goes on. It's part of the business. You can try to eliminate it, but it's part of the business. So you don't do it usually for normal things. It has to be something that people would not normally expect. So which one of these would be an other matter paragraph? Which one do you think? I'll tell you what, I'll make it even easier. Normal uncertainties are not in there. You know, someone may trip and fall in your restaurant. So, you know, that's a normal, that's not. So normal uncertainties are not in there. And D, you know, this one isn't right either. And you know that because it's discretionary. The auditors don't have to put these in. You know, this is extra. So it's not going to be required. Now, these up here are, you know, these are required. These down here are discretionary. They're up to the auditor. So between B and C, which one would most likely be an other matter? Oh, come on, get that coin out. It's B or C. Okay, you don't have to do this, but I'm going to make you watch the dancing dog until. Which one is it, you think? B or C?
B.
Probably be C. But thank you for a minute. So it's usually for things that are unusual. So things that are different than say normal. Now, for this one, uncertainties can be reasonably estimated. If they can be reasonably estimated, they should probably be either in the financial statements or in the notes. You know, if you can get an estimate on it, you know, oh, this is a lawsuit which will probably cost us $5 million or whatever it is. So if you can reasonably estimate it, it's probably it should be either in the notes or it should be in the financial statements usually. So if they can estimate that, so this is for the unusual things, whatever it is. I'm sure a lot of companies this last year got these for the COVID thing. You know, it's uncertainty. I don't know. Never had one of these before. What, you know, I don't know what's going to happen to the company. So, you know, that would be a good one. I mean, who in their right mind would have thought that it would be some kind of a virus that kills millions of people. You know, so, you know, that would be an uncertainty that would certainly, I'm sure that there were other matter reports that said, oh, by the way, we're in this crazy thing that has never happened before. Okay. Other matter paragraph issued for additional circumstances that may include all the following except. So which one of these would you probably not put in as something special? Let me give you an example of a subsequent event. So let's say a large merger with a competitor. Subsequent events are things that happen after the date. So for instance, a subsequent event would be, you know, okay, so for instance, let's say that a client merges with a large competitor on January 20th. right? This happened after the year end. Oops, yeah. Hey, I took my highlight. So it happened after the year end. So it's the financial statements at December 31st won't have this, right? But you may want to tell the reader, hey, look, by the way, this company's twice as big now, or whatever. So A would definitely be a other matter. So among these three, which one would probably not be big enough that you would put this in an other matter?
B.
Yeah. Yep. Yeah. Yeah. This be that you couldn't verify, some of the inventory couldn't be verified. Now, if it was significant, you could. It should be in the audit report itself if it was a big problem. But this is not something you generally would put in, tack onto this extra paragraph. An inventory item could not be verified. That's sort of your problem. It's an auditor problem, not necessarily something that anyone else would be too worried about. But major catastrophe, hurricanes, things like that. Related party transactions, suppose that they have 40% of their business is with related parties. 40% of their businesses with people who are relatives or whatever, people working in the company. Now, related party transactions are recorded in the footnotes, but you may bring this to the people's attention, saying, look, let's if there's a significant amount of related parties, you may say, look, that this could be a problem. Okay, group auditor. This one I got to do some writing, and I got to use a piece of paper. Okay. Which the following is not true of the group auditor, main consolidated auditor, and the component of the subsidiary relationship. Okay, so I'm gonna switch here. Here's what this is all about. I don't think it's focused. Okay. So let's say that we have a fairly good sized company. We have IBM. And we have the CPA firm A, and CPA firm A does the audit. This is what's known as the group auditor. As a group auditor, because IBM may have subsidiaries. So let's say that IBM has a subsidiary. Called Minicorp. So they have a subsidiary called Minicorp, and they may have CPA for B. That does the audit of that. This is what they call a component. Okay, so IBM, I should have probably made IBM bigger. Okay, IBM's big. So Minicorp, let's say the materiality here is $100 million. And down here, materiality is $2 million. Okay, so you have a CPA firm B doing the audit of the subsidiary, and CPA Firm A is the group auditor. They're doing IBM, but also all of IBM's subsidiaries. And there might be a whole bunch of subsidiaries. So that's what I call the group, the entire group. So IBM owns a subsidiary. The subsidiary is getting audited by another CPA firm. And CPA Firm A is auditing IBM. Now, when they do the audit report for IBM, they have a decision to make. You know, are they going to put in that audit report that another CPA firm was involved? Are they going to say, oh, the subsidiary mini corp was audited by CPA Firm B? It's up to the group auditor to decide this, whether they want to list them by name or not, and split up the responsibility. So, you know, here's the question: do you want to? You guys can't see this. So you want to include, I'm not sure why I put an R on the end of include, CPA Firm B in the audit report. If you do, it's another paragraph. If you don't, you're going to accept the responsibility for it. Another thing is that materiality is going to be based on, you know, for the group auditor, the materiality is going to be based on materiality for IBM. For the component auditor, it's based on the mini corp. And, you know, if they have a misstatement here of say $5 million, they say, okay, that's material, right? That's, you know, they'll get you a bad report, right? It's misstated by 5 million. We're saying materiality is materiality is 2 million. They may get an adverse opinion. IBM may not get an adverse opinion because $5 million is not material to IBM. So these two will have different amounts of materiality. And again, even if they have an adverse opinion down here, it may not have any impact up here. 5 million is not material to it. All right. Enough of that talking and stuff. So which of the following is not true for the group auditor? Which one do you think it is? I think I just talked about it.
Is it C?
Yep. Good. Yeah, the material is not going to be the same. The group, you know, the main company is going to have a larger, because it's going to have their own plus whatever it is in the subsidiaries. The rest of these are correct. They may decide to share. Again, these are discretionary. They don't have to share the responsibility, but they can. By the way, this is for US only. International standards do not allow you to share the responsibility. You cannot share the responsibility if you are international. If the responsibility is not shared, the group auditor must perform additional procedures. That's true, because now you have to get familiar enough with the subsidiary to to make the audit for IBM. And this one is also true. They're never forced to rely on the component work of auditors' work. So in other words, if you look at their audit plan and their audit program that they've done, and you say, okay, this is inadequate, this, your evaluation of inventory is not up to level, you can do your own evaluation. So you're not forced to rely on their work. Okay. Modified opinions. What time are we at? Well, we'll be closer. Modified opinions. These are bad opinions. These are bad opinions. And they're rare. They're rare because usually the clients will see the light and correct the financial statements. I think we went over these, didn't we? Like first or second? I think we did. Like I can't remember, to be honest with you. I thought we went over them. Okay. The first type of an opinion, the first type of bad opinions is a qualified opinion. And a qualified opinion is this. It's material, but it only impacts one account. It is not pervasive. So so a qualified opinion, it usually only affects one account. It doesn't go all throughout the financial statement. So they say, okay, there's a problem here with the accounts receivable. There's whatever. There's some foreign government receivables that we can't verify or whatever. But overall, the financial statements are, you can tell the financial statements are fairly presented. There's this material misstatement, but overall, they're, as a whole, they're fairly presented. The sales are correct, cost of goods sold are correct, whatever stuff. It's just that we have this problem with this. Usually, it's just one account. So if there's just one account that has this material misstatement for whatever reason, a qualified opinion is appropriate. It's still a bad opinion. And by the way, these are, a qualified opinion is also known as an except for opinion. Except for opinion, and that is because the way it's written up. Oops. It says everything is okay, and then they'll say, except for and it'll be the bad stuff. So qualified opinions are also known as an except for opinion. And the reason being is that the way it's written up, it'll say, these financial statements are fairly presented, except for, and then they say the bad stuff. So a lot of times it's slang or whatever you want to call it. But you'll hear that they got an except for opinion. That's a qualified opinion. Okay, adverse opinions. These are the worst ones. And it is, well, you can probably guess, material and pervasive. In other words, it goes throughout the entire set of financial statements. In other words, these are not GAAP. And they should not be relied upon. So an adverse opinion is the worst one. Now, for both of these, the qualified and the adverse, the amount that they are misstated, misstatement is known. So, the dollar amounts. I should. So the amount of misstatement is known. For both of these. So a qualified and adverse opinion, they both have known amounts of their you're gonna say this is misstated by whatever, and you're gonna put that right in the report. Those amounts will go right in the report. You're gonna say, sales are overstated by 38 million or whatever. Known dollar amount, so those dollar amounts will go in the report. They'll go right in the report. And this is why these opinions are rare. Because even if the client refuses to correct them, everyone's going to know about it. And not only going to know about it, it's going to make you look bad, even worse, right? Because now it looks like not only are your financial statements, but you're trying to hoodwink people. So the amount of misstatement, if it is, it's known, it'll be in the report. And you'll virtually never see these for publicly traded companies. Because if they have a bad opinion, qualified or adverse opinion, the SEC will immediately stop trading your stock. So you never will see these basically for publicly traded companies. It would be just death knell. The financial statements are, they have a qualified or adverse opinion. Okay. Now, disclaimer. This is when the misstatement if any is unknown. And this is no opinion. A disclaimer of opinion is really no opinion. It's when you can't get enough evidence. They can't get enough evidence. They can't form an opinion. So the same amount is unknown. So unlike these up here, where you can say, hey, these are off by $38 million. For a disclaimer, you can't tell them that it's off. but you don't know. They might be 100% correct. They might be materially misstated. You don't know. It's no opinion, and it's sort of like nothing. It's like, oh, here's our bill, and here's nothing. Here's this disclaimer. Okay. How about this scenario? So you're gonna give someone an adverse opinion, right? They got an adverse opinion, and they say, no, don't give us an adverse opinion. I'll tell you what, just give us a disclaimer. Don't give us an adverse opinion, just give us a disclaimer. Can you do that? What do you think? Yes or no? You got a client, the financial statements are materially misstated, it's pervasive. And they say, oh, don't give us that adverse opinion. Just give us a disclaimer, so, you don't know. Can you do that?
No.
No. Yeah, you can't do it because a disclaimer says that you don't know. An adverse opinion, you do know. Yeah, and so it's sort of like a fraud to say, I don't know, right? When actually you do know that they're misstated and how much they're misstated by. So you can't bargain away an adverse opinion with a disclaimer. Okay, let's go ahead and enter that for the poll. What do we have left here? I can't remember. And we'll skip those. Scope limitations. I'll tell you what, I'll answer them just in case you guys want them for your own thing. But go ahead and put in things. I'll answer these. The most serious of these would be when a client doesn't allow you to see something. But I think we talked about this already. If a client is really saying, don't look in this closet. You can look at every place, but not in this closet. Well, first thing you want to do is look in the closet because So whenever a client imposes a scope limitation, which is basically the auditor can't obtain evidence, that's the most serious one. If the client had a fire and that's why you can't get the information, or if they're hired after year end for whatever reason, maybe their regular auditor got sick, they had to go to the hospital or something, and you came in after year end, that's different than someone refusing to give you information. Okay, scope limitation that is deemed possibly material and pervasive should have a disclaimer. So it's possibly material and pervasive, disclaimer. Scope limitation being possibly material but not pervasive, you'll notice that material and not pervasive is very similar to our qualified, right? Material but not pervasive. So if the scope limitation is possibly material but not pervasive, there's only one account, say, you can give a qualified opinion. And a qualified opinion is way better than a disclaimer. Because a qualified opinion says, look, everything else, everything's pretty much okay, except for this one account we couldn't verify, and you'll say what you couldn't verify. But a qualified is much better than a disclaimer. A disclaimer is nothing. Here's nothing. Whereas this will say, okay, the sales are correct, the cost of goods sold are correct. It's just, And last, and certainly not least, is maybe it is the least actually. A scope limitation that is deemed not material and not pervasive. Kind of opinion, clean. It's not material and it's not pervasive. It's a clean opinion. For instance, they got a new desk and the old desk had all the receipts for the petty cash. So we can't verify petty cash. Well, petty cash is probably not material anyways. So even if you can't verify any of the petty cash, it probably doesn't matter. So it's a school limitation. You can't look at those receipts, but it's not material, it's not pervasive. Standard report. You don't have to turn those in. Okay, is anyone still working on the questions? Figure out 4 out of 5. I'll leave it open for a little bit longer. And that's it for the class. So here is what's going to happen next. Oops, what am I doing here? I gotta get my to-do list back up. Okay. Well, I'm glad we got through what we got through. That was. I thought it might be maybe a little too ambitious. So here's what I'm going to do. I'm going to make an exam over module B and chapter 12. And there'll be a little bit more. Well, the module B one, it'll probably be a little bit heavier towards the module B, whereas the chapter 12 will be a little more definition in here. Yeah, so, okay, let's examine module B. Chapter 12. And I should get that out by tomorrow. I'm going to try to get it out tonight, but certainly by tomorrow. It's the last exam we'll have, and I'll put a drop for the chapter 12 handout. I think the module B is already in there. It will be due Friday, May 7th. I'm going to check that just to make sure I'm not telling you guys lies. Yeah. Okay, so I wish they didn't have that in a module. I don't know why it just bugged me. It's like, why don't you just call it a chapter? But anyway, so I'll put those. So it's basically it's on module B, which is the independence stuff, and then chapter 12, which is the reporting. And one more thing, and that is that the work is due by Monday, May 10th. Turn in any makeup work. All work. Work. Not word either. All work turned in will be given full credit. So there's no reason not to turn it in. Like, oh, I'm going to turn this late, I'll only get 50% or whatever. Everything you turn in will get 100%. Or, well, I shouldn't say, it'll get full credit, whatever that credit is. So turn in anything that you are missing. Will be welcome with open arms, and you'll be given full credit. So if you are missing anything, turn it in. There's no reason not to. Everything and all the handouts and all that stuff are in Blackboard, and all the Zoom classes are recorded, so you can always pull up the Zoom class from whenever it was, and it'll match up with the handouts. It may not be terribly interesting, but it they're all there. So, any questions on that? Next week's class. Oh, I gotta put this in. Next week class is not required. This will be a tutoring session. Well, tutoring, anything you want to talk about. If you want to talk about something else in auditing or accounting or careers or anything else. Well, it will be optional. I'll be here and no new material will be covered. So next, so if you're all caught up, and I'm going to send out the test here, module B in chapter 12. You're not required. You're welcome to come by all means, but you're not required to come. And I will take the. You will not need to turn in the chapter 12 or 19 handout, because I will take it off of the multiple choice. I think this is why I'm going to do these in the future. Maybe get a little bit better at. You guys probably gathered. I'm more of a classroom teacher, and so I'm not the best at this distance learning stuff. So, but anyway, if you have me again, hopefully the class will be a little bit more smoother. So anyway, I'll take it off as multiple choice questions though for the as far as getting credit for the handout, and that'll be it for the course. Okay, is anyone still working on the multiple choice questions? If you're working on it,
Professor, I have a question.